Okay, welcome everyone. We'll start our lesson 3. Today lesson we look our learning outcome 3, which is be able to prepare financial statement for a group of entities. So in previous lessons we discuss about how many types of statement we prepare in accounts. Anyone knows how many type of statement we prepare in accounts? Yes, we know 4 types of statement we prepare in accounts. Yes.
Yeah.
So
Yeah.
we discuss statement of comprehensive income, which is also known as profit and loss
Yeah.
statement,
Yeah.
statement of financial position, also known as balance sheet, statement of cash flow, cash flow statement, and statement of chain in equity, or we call shareholder statement.
Yeah.
So these statement main purpose to provide the true and fair information. We discussed various standards in the previous lesson. Today lesson we will discuss about group. If we'll take other company or we merge with other company, what will be the criteria or the rules to prepare the financial statement? There can be different issues, the timing, the legislations. Yes. So
Yeah.
each country different standard, but here we're looking the IS International Accounting Standard. We can discuss about 27 IFRS 3 combination of two business when we combine them. So different treatment. So I'll try my best, to cover everything. So first of all, what we know about parent company.
Yeah.
How many shares they need to be own for other company or take our other company, and we call parent. Anyone we know how much? Is it more than 50 or less than 50? So if you
More than 50? More than 50?
if you own more than 50% of other company shares, we can
Yeah.
call this is the subsidiary of parent.
Yeah.
So that's the subsidiary. If you own the shares 20 to 49%
Yeah.
of a company, we call this is associate company. It means you don't have fully control on it, but you have a significant influence on it. But
Yeah.
this 50% and more, you have a control on it. Okay, if you have less than 20% shares in other company, less than 20%, it means you have simple investment. We can't call associate or subsidiary. So see, this is a simple investment.
Okay.
So that's the treatment. So when we do subsidiaries, their assets and liabilities we combine. When we do associates, so we don't do there, but we just put single line treatment. How much investment we have, and in terms of investment we do the treatment. And if it's a less than 20%, it's simple. You bought a shares in other company, you have investment in it, and you can get
Yeah.
the dividends from others. That's all. Okay. So first, we have 3.1. We supposed to be prepare the statements, prepare group accounts. So group accounts can be all 4 types of statement, but they specifically here mention the cash flow. We know the cash flow is we prepare under IS 7, and of course cash flow mean in and out cash, and we'll try to reconcile where the cash been used, where the cash came from. Two method we use, indirect and direct method. Doesn't matter, it's only we looking how much cash and where the cash is gone. One is more detailed and one will summarize. Any question?
No, this is fine. Yeah.
Okay, so this is the format when we'll start to prepare the cash flow statement. This is a direct method layout, and this is indirect method layout. Normally we just use indirect method, not specified, whichever method you use, end of the day your balance will be the same. Okay. So profit before tax, we can find the figures from our profit and loss account. Then we make adjustment. So first of all, always we try to prepare the operating activities. Operating mean our normal business day to day. Yes, like if we look, the Tesco's normal business is buying and selling, yes, consumer goods. But Tesco is not only in consumer good, they are in banking, they are also in construction, they invested money in energy. So those will be investing activities in different businesses. But
Mm,
their main business will be operating activities.
mm,
So
mm,
we can separate, the cash. So when we start profit from before tax, the figures, and then we need to make adjustments. So finance cost, because you minus finance cost, which is mean interest, you can add it back here. Then
mm,
depreciation. Depreciation is a non-cash expense. You always add back. Dividend received. Dividend received is a income, but this is not a routine. This is come under investing activity. That's why we have received the
yeah.
dividend. So it should don't come under the operating. It should go. So first place we add it as an income positive effect. Now we are minus it. We're doing reverse it. If you
Mm,
have a gain on properties, plant, equipment, so first place you add it in the income statement, or we call the statement of comprehensive income. Now you are minus it because this is part of investing activity, so it should go under the investing. Then
mm,
inventory, these are the, of course, we know current assets, current liability, any changes during year, increase and decrease. If the inventory increase, it's a negative effect on the cash, because cash is sustained in the, or cash is really stuck in the inventory. So negative effect. So if the inventory decrease, it means inventory went out, the cash came in. So that's, the positive effect. If the trade receivables increase, it means the cash not received is a negative effect.
mm,
And the trade payable, if we paid off, it means the negative effect on the cash. Payable increase, positive effect. If the payable decrease, because my liability decrease, why my liability decrease? Because I paid off. My cash position will be down.
yeah.
So that's the way, we can look around. Then we can say cash generated by operation. Then again, the finance cost. Yes. Here we
Yeah.
make, we can look around any figures given in the previous year, or how much we make overall payment during that figure. But when we just look in the profit and loss, maybe that figure is included only this year, not the previous year. Because the
Mm,
profit and loss we prepare from the historical figures. But when we
mm,
look cash flows, we look all the money in and out during year.
mm,
Okay, tax paid. So always look the previous year tax liability plus this year tax liability minus end of the year. Still we have a tax liability to pay. So whatever will be the difference, that will be our cash being used, the tax being paid, and
mm,
remaining
mm,
will be liability. Because we're looking in the cash perspective, we're not looking in the profit and loss perspective.
yeah. Yeah.
Okay, so that cash from operating. And then next we go through net cash from operating. Then we look the investing activities, purchase of property, plant, equipment during
Mm,
year that went up. It means our cash went down, because if you look the last year non-current asset figures and this year non-current asset figures, if it went up, why went up? It means we purchase more. When we purchase more, it means we paid cash more. Yes, so that's in negative effect. Proceed of disposal. When we proceed, like in the, we put as a gain in, but here we're not just only looking the gain, we're looking the full proceed. If we have a gain, it means we sold it. We know NPV, NBV, net book value. Yes.
yeah.
So if the net book value was 300 and we sold it 360, so 60 is my gain. Yes.
Yeah.
300 is my book value. So when I will proceed will come 360. So it money came in the business 360. So
Mm,
that will, because in the profit and loss will only show 60. Yes, as a gain.
yeah.
But here under the investing activities will proceed will be full 360. So we'll debit the cash and credit the
Mm,
360 as a property plant equipment value. Okay, and 60 will be the gap that goes on the credit. Okay, so interest received is income. Yes, when we invest others, we receive the interest. Or we deposit money in the bank, we are investing money. So dividend we received, yes, that will
Yeah.
be our income. So increase the cash. So we can adding positive and minus negative. So what with if we have normally most of company carry on investing in the non-current assets, so their cash flows come under investing negative cash flows. Okay, then we
Yeah.
have a financing. If you want to be think about sources of finance, we can raise money to issue the loan, to borrow the money through the bank or various financial institution, or issue shares to the public. Normally, equity financing is expensive than the loan, so that's why most of you will see that liability is higher than the equity figures. The
Yeah.
reason is because, of course, that's the cheaper way, but there we need a balance. 60% is a loan, 40% is equity. Yes, equity mean you're a owner. So here we look the financing. If my share capital equity figures went up compared to the
Mm.
last and the positive cash flow, if they have went down, yes, we pay back or buy back, the shares that can be negative effect on the cash.
Yeah.
Uh, increase in the bank loan if we have it mean my liability went up. Why my liability went up? Because my cash balances went up. Yes,
Mm. Mm.
because we borrow more. If we pay dividend on
Mm.
shares, because we borrow money through shares, we have to pay dividend. The dividend received was income, dividend paid was expense, but the dividend paid is reduce my cash balance
Mm.
under financing. So that will be my net effect. So we can say, let's say operating is positive,
Mm.
investing is negative, and negative. If you positive minus negative negative, we have a positive more, so our balance is a positive from net
Mm.
active, all these activities. Plus you add the opening balance, which is given in the financial statement, which is mean the last year closing cash balance.
Mm.
Yes, this year opening. And then if you add these two, that will equal to this year cash balance, which is given in the balance sheet. If that's equal, it means you did the really nice reconciliation of the cash, where the cash being used. Any question?
Yeah. Well, under this, okay, we do not consider the debtors and trade debtors and trade creditors, isn't it?
We do under the operating only,
Okay. Okay.
because the current asset is mean operating activity that will change within 12 months.
Okay. Okay. Mm.
Yes. So because
Mm.
we say current liability must be settled within 12 months. Yes.
Okay. Okay. Yeah. Mm.
So non-current is long term that come under financing. Okay. To clear this, I uh, included the slide for you and look around the question. Question will be 6.3, 6.4,
Yeah.
6.3 and 6.4. So we have answers as well, which will be available on Moodle. So if we'll go back to the question 6, and what is chapter 6? So this handout is one of publisher is called Osborne handouts. So
Yeah.
he normally use for various. We can include further, more complicated ones or simple, adjustments. So
Yeah.
for us, because this your course is more assignment, no exam, so we'll
Yeah.
focus more. Just you have a handout, you have a concept. So
Yeah.
here 6.2 we said 3 and 4. So this is the 6.3. We've been given the profit from operation. We've been asked to prepare and we've been given the balance sheet, yes, end of
Yeah.
year adjustments, and then we've been asked to prepare the statements, yes,
Yeah.
the
Right.
operating activities, cash
Mm.
flow, yes, and we can prepare
Mm.
these statements. So what we can if you can, if look around the answers for these, and then of course if any point you think, oh no, not make sense where these figures came from, you let me know so we can go through full question with you. Yes.
Okay. Yeah.
So like now 6.4 or 6.3. So you will see here all being solved up. So like profit.
Yeah.
So the figures are given really. We just need to be follow the pro forma which I included in my slide, and we look it
Yeah.
up and we make it. And then they did prepare the operating and then investing and financing. That become full, the question.
Yeah.
And even the statement. Then it's 6.4 is also the same.
Yeah. Yeah.
So that's your cash flow statement, the way we can prepare. And then we can look around 3.2, prepare the group accounts incorporating associate and joint arrangement. A group of the company consists of parent, as we mentioned, its subsidiary. IFRS 10 is a standard as well. A parent is entity control, one or more entities, subsidiary. It can be more subsidiary. Some companies have more than 50 subsidiary. There are the tax to save the tax, to transfer pricing, and all these issues come because it's management and financials. They always look, to save the taxes. Yes, to look
Yeah.
around the future businesses. That's why they always, different subsidiaries. So that's why you will find, if you look the Tesco's financial statement, you'll say the group statements consolidated because they have a banking, they have so many subsidiaries in different part of the world even. Okay,
Yeah.
so then entity is mean the organization control, yes, have a power. Yes, you remove the directors, chain management, and ultimately shareholder are the owner. So when we look the group, so we're looking how much shares if we acquire 80% shares, yes, so we have 80% control, so 20% we have a non-controlling interest.
Yeah.
Yeah. So always we looking the goodwill. If we learn about net asset, yes, total asset minus liability equal to net asset. If net asset was, let's say, 300,000, yes,
Yeah.
and purchase consideration we paid it 360,000. Why we paid 60,000 extra? Due to the goodwill.
Goodwill. Yeah. Right. Yeah.
So that's the way, we can look around, or you can find the net asset always equal to equity figures. If you have equity figures at the date of acquisition, it means, and if you're paying more than that, you have
Goodwill. Yeah.
purchase consideration plus we have a 20% non-controlling interest. Yes.
Yeah.
And then minus the net asset, and you will get. But sometime goodwill can be impaired. Impairment is mean loss. Yes. Let's say 60,000 was goodwill. If we'll say 10% in a meanwhile is impaired, yes,
Yeah.
the value of the company drop. So 10% here can be 6,000. So we can say 60 minus 6 equal to 54 is my goodwill. Yes, after. And this 6 is my loss,
Yeah.
which goes in the profit and loss. So the steps we need to be follow in step 1, step 2. When we prepare the group return earning, always parent is always doesn't matter is a pre and post acquisition, when we acquire or when we not acquired, but subsidiary always post acquisition because we don't have any control before acquisition. Yeah. So that's why, we do post acquisition. Non-controlling interest, whatever the equity figures total, that percentage of that will be our non-controlling interest. Simple. Because equity figures always contain of the shares and retain earning, any fair value or revaluation reserves. Yes, that's also part of the equity. And that's, the way we can calculate our non-controlling interest.
Right.
Any question?
No. Thank
Okay.
you.
Maybe in a lesson, of course, we not, but to address this, I copied here link for you to look around and
Yeah.
look some questions based on the steps
Yeah.
we've been given. Follow the
Right.
template, and then if we prepare the income statement, yes, so that need to
Yeah.
be consolidated. If we have an intra company, when we are in a group, we are one company, yes.
Yeah.
If we
Yeah.
do trade between us, that's not our sales. If we sold outside the group, that will be our sales.
Yeah.
Yes. But you're preparing your own statement, I'm preparing my own, and when we combine together,
Yeah.
if we do any trade between us, we need to eliminate it. Any
Okay.
profit you saying you earn it, but you earn from me and I earn from you, that will be called unrealized profit.
Mm. Mm.
That shouldn't be realized in our statement, yes?
Yes.
But if you sold that goods which I sold you outside the group, someone else, then it's fine. Then you're
Yeah.
profit.
Yeah.
So that's in call. So we prepare these where we combine our revenue, combine cost of sale, but any intra-company adjustment if we have, we eliminate, and then we finance costs all, we combine them, yes, and we can prepare the statement of profit and loss, or we call statement of company. This is all adjustments, and I
Yeah.
included question 8.4 and 8.5 for you. So if we'll go back to these handouts
Mm.
and we look 8.4 and 8.5, so that's chapter 7, we'll go chapter 8. Yeah, so we said 8.7. Yes, full-fledged question. So yes, so these
Yeah. Yeah. Yeah.
are the consolidated. And to address it, so go back 8.4, 8.5. So 8.4, 8.5. So you can look around answers which is given in the answer handout as well. So same way you prepare the template, use the template from slides. Yes, you will see here we've been given, so you're adding them both companies revenue if we are preparing the profit and loss. Yes.
Yeah.
If any intra-company information is given here, yes, you will see
Yeah.
there requiring 75%. So 25 will be non-controlling interest, and this is a consolidated profit and loss, and that's, we can look around, we can follow the step. If you're preparing the balance sheet, yes, consolidated, and where we have to calculate the goodwill, we've been given which date we acquired, yes, how much we require, so all, and you can look around handout, this answer sheet, and where we can look around steps. So like show you here 8.4 and 5.
Mm.
So 8.4, you will see here, yes, we combine.
Yeah.
We've been given attribute is mean, how much profit we need to divide between us, and rest will be non-controlling interest. Okay. So all the working there as well, yes, when we combine, and then you will see here 8.5, how many were shares? Total share were 1 million, and we acquired 600,000 shares. So it means we acquired 60%. So 40% will be my non-controlling interest. Sometimes they don't give you percentage, you have to calculate your. So what are the fair value? Fair value mean the market value that was there. Carrying value was this. Carrying value was less than, so there is need adjustment of 600. Yeah. We do debit the non-controlling interest, non-current asset, and credit the revaluation reserve, the double entry treatment. Then goodwill purchase consideration. What was the, because 60% you acquired, So 40% will be your non-controlling interest. So how
Yeah.
much worth of the asset were? So at that date we've been given, we calculate the 40% of those. Yes, net asset required,
Yeah.
that was there, and the 40% of that we calculate that came non-controlling interest. Then net asset, we know net asset mean asset minus liabilities, or you simply look at the equity figures. Yes, when we add these two and we minus this, our goodwill came, and then they said 10% of the goodwill impaired. Yes, so we calculate 10% of that goodwill is impaired. So we add that become 7,980. Yes, we minus 7,450, and then 10% of the goodwill was impaired, which is 5,300. Yes, the 530. Sorry. Yes, so 53 will be R, and remaining 530 minus 53. Yes, that will give us 477. Net goodwill. Any question?
No, that's fine. Yep, that's okay. Yeah.
Okay, that's the way. Then non-controlling interest. All these, the working we are going to combine here. That's consolidated. So we add the goodwill was, yes, in the working. Tangible asset, we add them together, both companies. Doesn't matter dates and things, because that was the revaluation when we acquired, yes, asset went up. So we add them back together. Inventories and all current assets, we add them together, both companies, and that's equity. Equity is always parent, please. And there's parent share capital, parent share premium, and the retained earning group, which we calculated. All the parent and subsidiary after the acquisition, if the company earned the profit of the subsidiary company, not our company. Parent. Okay. And then non-controlling interest is the percentage, 40% of their equity end of the year. That's figure there. And non-current liabilities, just add them together, both companies. Current liabilities, add them together, both companies. Yes. And that's the way, of course we know that this figures is the total equity and the total asset figure should be the same. Yeah, that's the way we prepare the balance sheet, or we call statement of financial position. Okay, so that was our 4 and 5, which we can look around. Of course, a few different sort of a time period adjustment we can look around in different questions. When we prepare the group structure, they involve the changes in the group structure. Of course, changes can be if one company owns more than 50% ordinary shares in another company. This will usually give the first company control. The second company, like we added the example of P, and is defined under IAS 27, consolidated separate statement issues following subsidiaries. Yes, control more than 50%. As I mentioned earlier, we mentioned here what is the consolidated. When you prepare, these issues can be intra-company trading, which I mentioned here. Can be group trading, and that's we have here. And to address this, I copied the link for you. What you can do, copy the link, and you can read different issues. Yes, intra-company. That's I'm holding 20%, you holding me 30%. What is my I'm holding outside? So these issues we need to make adjustments in our final accounts. So that's some issues is being given in these links. Other than that, I copied from the handout 8.6. So if you look the question 8.6, yeah, that's exactly the same, but only like acquisition can be at the start of the year, at the middle of the year. When you have at the middle of the year, so 6 months can be, let's say you mid of the year, 6 month pre-acquisition and 6 month is post-acquisition. So your profit need to be divided to, when you prepare the group consolidated, the group, so group retained earnings should be only half of it, the profit of the subsidiary. half of it should be included in the group. So these sort of the issue is that's when we'll prepare assignment we can add example. Then we have 3 merit criteria. Look around the accounting requirement. Foreign transactions. Foreign transaction is outside due to the increasing globalization. We have issues we dealing with the foreign transaction. There is a hedging as well, yes. Hedge and treatment. We'll maybe learn about hedge, yes, to protect our foreign currency fluctuations, yes. Which value will show, because every day's value of the currencies change, yes. It's very difficult, when we convert it, and which, we can easily creative accounting, we can use it, huh? We can show higher value to look, our figures good.
Yeah.
But we need to be use the standard IFRS, yes.
Yeah.
And we given the guidance in different part of the world, and to look around different issues, I copied the link for you if you want to work towards merit criteria, yes.
Yeah.
And we can pick 1 or 2 examples, so that will be hit the criteria. Then we have a distension. If you want to evaluate, prepare detail, which you already prepared in the previous one, yes, where we can, but we can expand them, evaluate to pre and post, and with this group company group statement with your competitor, so you're evaluating the changes, or the changes itself in the legislation, or after adjustment, after fair value adjustment, like asset value went up, but we've not adjusted before. But when people heard Morrison is going to take over by one company, Liberty Group, I think so, in America in next few years, next few months. So what will happen? So share prices of the Morrison is increasing for suppose. So this is the asset value is increasing. So we need to be make fair value adjustments. Huh? So that's because there is going to be happen. So what is the fair value? In the consolidated, so fair value mean the market value, goodwill need to be calculated, and adjustment if we have a gain, if we have an impairment, we need to be adjust the losses. And I copied the link for you here if you want to look around the distinction criteria ACC article here. That will also help us to prepare our consolidated financial statements. Any question?
No.
Okay. So that's the way we can address it. And if you have any question, please drop me email. And I hope so. I'll speak you. Oh, you're going to attend lesson 2 o'clock?
Yes, that's right. Yes, that's right.
Okay. It's just simple ratios we need to go through. That will be our LO4. And thanks for listening and attending. Please, when you prepare, when we'll go through assignment discussion, so we'll explain you further. But if you want to, for the sake of you want to do some questions, please, it's good to do, to enhance the understanding. If not, let me know so we can go through some question together as well.
Okay.
Thanks for listening and attending. Hope so. Speak during
Thank
that.
you.
Thank you. Bye bye.
Thank you.